This week felt like the whole financial world slipped on ice at the same time. Gold fell, silver fell, stocks fell, Bitcoin and Ethereum fell. Even the big tech world overseas had a panic moment. And on top of all that, global tensions made people even more nervous. When everything drops together, it usually means one thing. People are scared and rushing for safety, even if they're not sure what safe means anymore. Why gold and silver suddenly crashed. Gold and silver usually act like a warm blanket during cold times, but this week, even the blanket caught fire. Large investors started selling precious metals very quickly, not because gold or silver suddenly became bad, but because they needed cash. Fast. When big players need cash, they sell whatever they can sell quickly. And gold and silver are some of the easiest things to sell. Once the selling started, computers joined in, pushing prices down even faster. Everyday investors saw the drop and panicked too. This wasn't about the metals themselves, it was about fear. Why stocks around the world fell. Once metals fell, the fear spread. Stock markets around the world turned red. People weren't selling because companies were suddenly bad. They were selling because they didn't want to be the last ones holding the bag. When fear spreads, logic disappears. People sell first, and think later. A global map with red arrows pointing downward across continents. Glowing stock tickers falling. A digital stock chart collapsing with silhouettes of worried people watching. Soft cinematic glow. A stormy sky over a city skyline with red financial graphs floating above, symbolizing global panic. The tech shock from overseas in one of the world's biggest tech hubs. A new AI tool was shown that can work with people, manage tasks, and even help organize entire projects. This scared investors in the software and outsourcing industry. Not because the technology is bad, but because it might replace a lot of the work that humans do today. That fear caused a sudden sell payoff in that region's tech stocks, and because the world is connected, the shock spread everywhere. A glowing AI hologram rising above a digital city, while charts fall in the background. Futuristic tension. A network of code streams, shaking violently as AI symbols appear, representing disruption fears. A digital office collapsing into pixels, as an AI figure stands in the center. Dramatic tech industry panic. Bitcoin, Ethereum, and the crypto drop. Crypto didn't fall because of crypto news. It fell because everything else fell. When investors lose money in one place, they often sell their crypto to cover those losses. And because many crypto traders use borrowed money, once prices started falling, automatic liquidations kicked in. That made the drop even worse. Some people in the crypto world also worried about the future of software companies, fearing that if the software industry struggles, crypto might lose some of its biggest supporters. So crypto fell for emotional reasons, not logical ones. Geopolitical tensions add more fear. As if the markets weren't stressed enough, global tensions added more pressure. War in Eastern Europe fighting intensified again, raising concerns about energy supplies and stability in the region. Whenever conflict grows, markets get nervous, especially about oil, gas, and metals. Military buildup near the Persian Gulf reports showed increased military presence in one of the world's most important energy corridors. Any tension there can affect oil prices, shipping routes, and global inflation. When people see war and military buildup on the news, they naturally become more cautious. And cautious investors often sell first and ask questions later. The software as a service known as SaaS panic. Another fear spreading through the market came from the software service industry. The companies that run cloud tools, apps, and online platforms. People worried that AI might replace some of their services, their growth might slow there. Prices might be too high for the current economy. This fear added even more pressure to tech, stocks and crypto. Did the market bounce mean anything? After the big crash, the market went up the next day. That's normal. Markets often bounce after a big fall, but a bounce doesn't always mean the worst is over. Sometimes, it's real strength. Sometimes it's just temporary. No one can know in the moment. Not experts, not analysts, not algorithms. And that's okay. What everyday investors should do now. This part is important, and I want to speak gently and honestly. This is not financial advice, but here are simple, Human thoughts that help people stay grounded during times like this. 1. Don't make decisions when you're scared. Fear makes people sell things they later regret selling. Take a breath. Let the dust settle. 2. Keep things simple. You don't need to understand every chart or every headline. Just focus on what you believe in long-term. 3. Avoid chasing quick wins. Fast money usually disappears fast. Slow, steady decisions tend to work better for most people. 4. Protect your mental health. Markets go up and down. Your well-being matters more than any investment. 5. Learn a little every week. You don't need to become an expert. Just understand enough to feel confident in your choices. 6. Remember, you're not alone. Millions of people feel confused during times like this. It's okay to feel unsure. It's okay to take your time. Closing message. This week showed how connected the world really is. A metals crash, a tech scare, crypto liquidations, global tensions. They all hit at once, but markets have always had storms, and storms always pass. The goal isn't to predict the future. The goal is to stay calm, stay informed, and make decisions from a place of confidence, not fear.
When the stock market falls, what should you do? 1. First, don't rush into buying or selling when markets fall. Your emotions get louder than your logic. That's the worst time to make big decisions. Think of it like driving in heavy rain. You don't speed up. You don't slam the brakes. You slow down and keep control. Same with investing. 2. Should you buy gold? Gold is like a seatbelt. It doesn't make the car faster, but it protects you when things get rough. But even gold can fall during panic moments, because big investors sell everything to raise cash. So should you buy gold? If you believe in gold long-term, then buying slowly, not all at once, can make sense. For example, if you want $1.00 worth of gold, buy $200 each week for 5 weeks. This way you don't care if the price jumps or dips tomorrow. This is called averaging in, and it keeps emotions out of the decision. 3. Should you buy stocks when they're down? Think of stocks like buying a good business on sale. If you believe in the business long-term, then lower prices are actually a gift. But only if you're not using money you need soon. You're not buying out of fear of missing the bottom. You're choosing strong industries, not hype. For example, if a company that builds essential technology drops 20%, that doesn't mean it's suddenly a bad company. It just means the market is emotional.
4. Should you wait instead of buying? Waiting is also a strategy, and a smart one when things feel chaotic. If you're unsure, it's okay to sit back and watch. You don't lose money by waiting. You only lose money by rushing into something you don't understand. Think of waiting as letting the storm pass before you go outside. 5. What about Bitcoin and Ethereum? Crypto is like a roller coaster, exciting, but full of sharp drops. If you already own some, the best thing is usually to avoid emotional selling. If you want to buy more, do it slowly and in small amounts. Never buy crypto with money you can't afford to see drop 30-50% in a week. That simple summary. Beginner friendly. Don't rush decisions during fear. Gold is for stability, not fast profits. Stocks on sale can be opportunities. Crypto is high risk. Buy small, stay calm. Protect your mental health first, friends. This is not financial advice, just a caring, honest way to think about investing when the world feels shaky.